Good afternoon and welcome to today's wealthmanagement.com webinar, Direct Indexing, Maximizing Tax Value and Fueling Growth. This webinar is sponsored by Adhesion Wealth. My name is Davis Janowski and I'm the technology editor for wealthmanagement.com and will be your host today. In a moment, I will be turning things over to our speakers, but first let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on their lower right corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on these icons allows you to open and close widgets on your screen, but will not remove you from the event. Located in the green resource list widget, you'll find the slide presentation, as well as a couple of other resources from our sponsor that are available for you to download. You will also find in the resource list widget the instructions for CE credit submittal. Please note, this webcast has been accepted for 1 CE credit hour towards the AEP designation program. Investments in Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. And we welcome questions about our topic and we'll answer as many as we can following the presentation. But feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Please also be aware today's session is being recorded and will be available for on-demand viewing. You'll be notified by email when the archive is available. Now let me introduce today's speakers. Barrett Ayers is president of Adhesion Wealth and one of its original founders back in 2004. He oversees the strategic direction and long-term growth plans for the organization. Clint Sorensen is the co-founder of Wealth Shield, LLC. For the last decade, Clint has been focused on innovative strategies for enhancing and accelerating the traditional investment landscape. Jimmy Goolsby is founder and managing director of Paragon Wealth Counselors. In his role, Jimmy brings a combination of 35 years experience and a passion to bear on behalf of his clients. Michael Mansur joined ORG Partners Advisor Group in 2019. As the firm's president, he primarily focuses on business development and strategic partnership initiatives. You can find more information about our speakers by clicking on the speaker bio widget at the bottom of your screen. Now, with that, let's get started. Barrett, the floor is yours.
Yeah, it's fantastic. Thanks, Davis. Really appreciate it. And for everybody who's attending, thank you very much for attending. And also thank you, the panelists, Clint, Jimmy, and Michael. The objective here today is really to kind of unpack what direct indexes are, how advisors can leverage them, the value to the clients. We're going to focus on a couple areas. We're going to talk a little bit about tax. We're also going to talk about customization and how direct indexes are uniquely qualified to help advisors take advantage of the intrinsic benefits of direct indexing. So, and I really have to emphasize what Davis said is we really want to take questions. We want this to be interactive. You've got a unique panel of folks here who have all sorts of different perspectives on this particular topic. So we encourage you to ask questions. Nothing is off limits. So with that, I also want to make introductions myself, a little bit about my company. My name is Barrett Ayers. I'm the president of Adhesion, as David indicated. Adhesion, we're a managed account platform for independent investment advisors. We help advisors who are looking to grow their business using third-party investment solutions, who really believe in the premise of outsourcing and using, like I said, third-party investment providers. We work, like I said, with investment advisors, and that, from my perspective, that puts us in a really unique position. We work with a whole bunch of different advisors. We work with TAMPs, wealth management firms. We work with kind of roll-up firms. We work with traditional wealth managers. We work with asset managers. We see all sorts of different practice types. So we understand the business. Certainly the rest of the folks on the call today understand the different perspectives as well. And I think personally in that capacity, we've actually been running direct indexes for 12 years now. So it does provide us with an interesting perspective, having also worked with many, many advisors over that time. So with that as a segue, we're going to jump right into direct indexing. So I think the first thing that makes sense to kind of level set and make sure that everybody understands kind of what a direct index is, it might make sense to back up and kind of understand a little bit about the investment premise behind direct indexes. Like I said, we work with a lot of advisors, and many advisors that we work with believe that there is a place inside of a portfolio for pure beta, for pure index-like characteristics inside of a portfolio. So historically, that has been achieved by inserting either an index fund or an ETF inside the portfolio and building around it, which is, for many folks, a very good solution. Sometimes it can keep the cost down. So direct indexing is really the next generation of that idea about achieving index-like exposure. So unlike an ETF or a mutual fund where there's a single position inside the portfolio, really all a direct index is allowing the underlying holdings that make up that index inside the client's account. So as an example, for the S&P 100, or in this graphic here, the S&P 500, let's say, really you would open up your client account and the client would own all 500 securities inside the S&P 500. What that means then is that there's individual tax lot ownership by the end client. What that then means is that there can be a tremendous amount of tax efficiency because, again, the client owns the underlying tax lots, and we can also layer a lot of customization and personalization on top of that portfolio. So I don't want to jump too far ahead of myself, but we're going to dig into kind of both those layers of benefits and customization here in just a minute. So I think another important proof point is that we're seeing direct indexes grow rapidly. In fact, we're seeing them outpace growth of ETFs and mutual funds by a pretty significant margin. Over the past 5 years, we've seen direct index usage triple, like I said, over the last 5 years. And if you look forward, we're also seeing growth expecting to outpace ETFs, mutual funds, and separate accounts. Now, we're not going to go into the detail about all the data and statistics, but I do encourage attendees to register so you can download the slides and find out additional detail. So the question then is really getting to the thesis and the premise behind the presentation today, the webinar, why the growth, right? Where's the growth coming from? Why is it? Again, the two primary reasons that they're better than ETFs is because we believe there's significant value in the way that the clients can hold the underlying tax lots and the ability to customize. So, and we think that there's a lot of growth on the horizon too. So I'm going to pause here and I'm going to ask our panelists for a little bit of feedback on this. So Clint, let's talk a little bit about that. You know, there's a lot of growth on the horizon. We see it coming. We're seeing it every day. I know you're a big advocate of direct indexes. Tell me a little about what you see on the horizon and where you think where the market could be going here.
Yeah, no, Barrett, I think that's great. And thanks everyone for taking the time today. And Davis, thank you and the wealth management team for hosting. Yeah, I think the future is bright for direct indexing. And I think, you know, the proof is in all these acquisitions that we've seen in the space. I mean, everyone's wanting to get in. It's the future of distribution. It's the future of investing, in my opinion. And the reason why I think that is I think it solves a couple things, not only the tax benefits, the customization benefits, but I think as an individual investor, it also does a lot from a behavioral perspective. Right, gone are the days where you have these novels, right, of trade confirms and complexity. Now clients get to kind of give into their aversion to ambiguity. They get to pick names that they know, an index that they know. They get to experience investing a little differently, and I think that's one really big thing. The next iteration is also going deeper into that customization to personalize for the individual investor. So back what we all got into investing for, right? Us as an investment research company, helping advisors customize investments for their end clients and match up goals, objectives, constraints, build an IPS, and then fulfill that IPS or investment policy statement with vehicles that suit that, right? And I think we're getting closer and closer to doing that in real time, personalized, almost in an automated fashion. And as fractional shares come online, right, being able to trade a lot of these names that are bigger share counts fractionally, I think it opens up to a lot of smaller accounts as well. And I think people are going to gravitate to it, not only for to personalization, but also aligning with values, right? Aligning the investment with their values or with their opinions on the overall economy. And I think the future's bright. And I think when you look at the deal flow, when you look at how fast this space is evolving, it's pretty incredible. And I know you've seen that, Barrett, right? 12 years doing it, and look at all the change that's happened over the last year. I think it's pretty incredible. So very excited about the space long term.
Yeah, and I think, and if I, you mentioned fractional shares, and I think about where the industry's going, and I don't want to get ahead of ourselves here, but certainly the idea that you can personalize a direct index, and something we're talking about in just a minute, hyper customization capabilities on a direct index. So again, you've taken this, these 500 holdings, and you've distilled them down to something more manageable, put them inside of a client account. Really, the trick that is, how do you harness that? What do you do with that fantastic investment solution now that you've got inside of a client account? The ability to personalize it, put things like ESG screens and constraints on the portfolio. Maybe you want to put maybe a momentum tilt on it, or maybe you want to put an income orientation on it. Once you break open that ETF or that mutual fund, your client's holding something, to your point, Clint, it allows you to have a different kind of conversation. So, okay, we got the S&P 500 in your client account. What are we doing now? Tell me more about how you want to tailor this to be yours. And it is a highly, highly differentiated solution that really delivers what clients are asking for. So I think that makes a lot of sense. So let me talk about something else for a minute. So we know that there's a lot of conversation happening around direct indexes. And I talk to advisors like everybody here does all the time. And I think there's a lot of confusion about what exactly a direct index is, right? So I thought it might make sense to just kind of step back and say, how does an advisor even implement it? Where do you go to get a direct index? There's probably different ways to implement it. There's different ways to harness it. So what exactly are the options? And so I thought it might make sense to just kind of look at the spectrum of options out there. And in my mind, there's really three different ways to get access to a direct index. So there are software providers out there. You could go to a software provider and you could license the software, and you could have that piece of software create a direct index. So when you're done, in many cases, the output could be a file, like an Excel file with a bunch of holdings on it. And then, of course, the advisor would have to trade those individual holdings. You could also hire a third-party separate account manager, and that separate account manager could take ownership and discretion of some of your client accounts and manage that under their discretion as a S&P 500 or some other direct index, let's say. So you've got one account tied to a separate account manager that's being managed to their direct index mandate. And this is a little bit self-serving, I'll admit, but you could also use what's called a managed account platform, a unified managed account platform. So I thought it might also make sense to step back and talk a little bit about a unified managed account, what it is, and how that vehicle itself is a way to supercharge and truly harness the value of a direct index. So just as an aside, a unified managed account is a single account managed by a firm like Adhesion, where you can put in multiple investment vehicles. So you can put in separate accounts and mutual funds and direct indexes and ETFs all inside of a single account, and it's managed and rebalanced, again, that single account through the use of what's called an overlay manager, which is what Adhesion does. So part of the value of a unified managed account is when you start to put in things like, as the graphic indicates in the background, a direct index core in the background, but then you've also got maybe some active managers around the satellites. And so here you've got kind of an active passive blend of portfolios, and they can all be talking to each other because, again, they're in a single account. And one of the real benefits of this, and we'll talk about this in a minute when we start talking about taxes, when, let's say, a large cap manager chooses to sell a position in one of the active sleeves, instead of selling it, the sell can actually be a journal of the holding into the direct index. So rather than actually selling, let's say, IBM, instead it gets moved over to the direct index. So suddenly you avoid the commissions, you avoid the gains and all the taxable consequences by simply moving it into the direct index core. And so this is a really nice way. We're seeing a lot of advisors do things like this. And again, it's the vehicle of the unified managed account that allows all this to work harmoniously together. So with that, I thought maybe it makes some sense to kind of drill down and spend a little bit of time talking about customization. And I know, Clint, I'm going to hand it back to you for a second. You can talk a little bit about, how direct indexes help facilitate customization within a client portfolio.
Yeah, absolutely. And I think, looking at, let's start broadly, right? Just from a portfolio customization perspective. Well, I'm a huge fan of UMA technology, to your point, Barrett, is the ability to build active, passive, core satellite, right? There's a significant amount of optionality when it comes to building a portfolio for an individual client and having that core, right? Where we know, for instance, in large cap growth, large cap value, large cap core in the US, right? Domestic equities, we know there is, there's a significant body of work that suggests that having that index, right, having that kind of as your quote unquote passive, not here to debate the active passive argument, right, or the nomenclature there, but having that base as a passive direct index, right, where you're catering to the investor makes a lot of sense, right? You get manageable, you get to be able to manage expectations, they get to know what they have, they can see the individual issues, right, and then you can sprinkle around customization around the outskirts or the satellites of the portfolio. So it's not only just customization at the direct index level, but to your point, I think this is a significant boost to the client experience to be able to create a portfolio like this that matches them. And with UMA, you actually have scalable customization. And I'm not an advisor, but across an advisor's book, right? We work with advisors all over the country. Having the ability to customize at the client level, leveraging UMA, leveraging direct index, it gives you different versions. So not only can you customize at the portfolio level, but now digging deeper into the direct index, now I get to the advisor, right? Gets to have conversations with the client. Hey, what do you believe in? What are your values, right? Whether it's biblically responsible investing, whether it's ESG, whether they have concentrated positions and you're mapping it into an index and you've got to work that out over time through what we call tax transition. Whether it be, hey, I'm about to retire. I need more income. So I need a growth and income strategy, but I want this direct index to have a growing income component, or whether I want to select for factors that maybe work in a different business cycle environment, like quality in a slowdown, or maybe it's small caps in momentum, or small caps in value in a recovery and expansion. I think those type of iterations I think we're at the very, very early stages of this, and I think they're going to continue to develop to create a really unique client experience. And the way I define risk, and I think most advisors define risk, right? Because we're helping advisors manage individual client money. The risk is the probability of that client not reaching their financial outcome. Now, that's not always just governed by market activity. A lot of it has to do with behavior and the response to market volatility. And so creating an experience that they have buy-in and collaboration with, right, for certain behavioral profiles makes a lot of sense to that and supports the idea that that client will stay in the seat, right, when it really matters. There's a reason why all these studies, like the Dalbar studies, show that the actual investor or the investments the investors are in earn more than they earn in the investment. And it's that a lot of that has to do with behavioral response, typically to volatility. But we can help solve that through this customization, through these conversations, and frankly, through direct indexing. And I think it's going to speaks volumes, and it works now, but I think it's going to continue to speak volumes going forward. And I'd love to hear from some of the advisors on the panel, because I think that is where I see this really taking hold in building momentum.
Clint, those are great thoughts, and thank you for having me today. This is an exciting opportunity, and it's great to be here this week. What I love about direct indexes is if we're just sitting in an ETF or an index and holding, there's this perception that we're not doing anything for the client. And my foundation is with ultra high net worth clients. So with direct indexes, we have the discipline and scalable approach. However, we're affecting change in portfolios, and we can explain why we're affecting that change. So to me, the most powerful benefit of direct indexes really is the behavioral side. It's a control that we're able to provide to clients, but with the efficiency of an index that's really key, so it keeps clients engaged. And if clients understand what we're doing and why, and they can see what we're doing and why, they're going to buy in and stay the course, which will allow them to hit their goals. And frankly, direct indexing, which I was exposed to through Clint several years ago for the first time, has really changed my business and how we serve our clients and advisors because of that customization, but it's customization with discipline and efficiency of an index.
I think for
Jimmy,
me,
I'd love to hear your, yeah.
Yes. Thanks, guys. I think for me, direct indexing provides us to offer a deliverable that's actually achievable when it comes to investment returns. I'm an old school guy. I've come from being a stockbroker to, managing UMA portfolios with active management. But what happens over time, the deliverable of even offering consistent index returns is unachievable, because once you start getting into that active management research chase of trying to find that one manager that can maintain, maybe offer excess returns to the index, is really mythological. I think it'd be a fascinating study if someone went back and looked at some of these GIC models at the major wirehouses, and I'm probably pushing the envelope here a little bit, but they're made up of UMAs and ETFs and SMAs. And I would suggest to you that over 10 years, the manager turnover has been absolutely epic. And the reason is not that these people aren't brilliant, they are, but it is almost as tough to pick the great manager as it is to pick the great stock. Whereas with direct indexing, I can look a client or prospect in the face and say, not only can I provide you index returns, which has already been noted as being in excess of what a true investor experience is, I have the opportunity to offer you excess returns over and above the index. Now, how do we do that? Because of the tax management feature of a direct index. A lot of studies have shown that you can add 100 to 200 basis points yearly of net after-tax return in excess of the index. You compound that over any reasonable period of time, that's a substantial outperformance compared to trying to chase who the great manager is and what is the best way to implement some assets into active management. So I think that's a very important thing. And I think two other quick points I would make to tax management is that one might come back and say, well, obviously a lot of managers, a lot of UMA platforms, a lot of model portfolios would have a tax management mandate or customization for a client. The problem with that, though, is that once you start overlaying too much tax management over an active manager, it becomes a performance drag for them. Whereas with a direct index, it does not, because like in my case, I use a Russell 3 core direct index. I've got 150 stocks that represent the Russell 3, and we can do tax management all day long, maintain a statistically meaningless tracking error, and not be a performance drag. So that's the other thing you've got to keep in mind with tax management with a direct index versus other UMAs or model portfolios or different things, is that if you start doing too much with an active manager, it's kind of like the old saying that we used to have with a client's account. The more that it's like a bar of soap, the more you put your hands on it, the smaller it gets. And that can be the case with too much tax management in an active management portfolio. Direct index is the solution. I'm giving you index returns and an opportunity to earn excess returns and literally deliver that versus make a promise that I know is not achievable.
That's Jimmy, that's a really good point. We hear advisors say that all the time. One of the things that we've started to do a lot is build these core satellite portfolios we talked about earlier with a larger core as a direct index. And to your point, what happens is when you've got your active managers who are smaller, more underweighted than the core, they're out there generating, mostly short-term capital gains, creating tax havoc in the portfolio. But yet we're in the core with 100 or 150 holdings and actively harvesting all the losses. So what happens is your active managers are creating gains, but the core is creating the losses to offset the gain. So at year end, you've now neutralized the tax impact of the active managers. You've achieved, to your point, statistically meaningless tracking error to the index, and you've got your managers on the outside who are swinging for the fences. And on occasion, they'll hit some, on other occasions they won't. So it's a very good point. And the other thing that it does too, when you put them all inside of a single account, and this is one of the things that people don't talk about much, is if you have, let's say, an active manager in one account and a direct index in another account, what's happening is people are buying and selling the same thing, right? Everybody owns Apple. If you're large, mid, international, all cap, everybody owns Apple. So what happens is one guy's buying, one guy's selling. They think they're both independently doing a great job. One's creating a wash sale and disallowing the loss for the other one. You put that inside of a single account, you're moving positions around, but you're not selling things, and you're managing the entire portfolio to a tax-neutral state come year end. So it is certainly a much better experience. It beats having to go to an accountant come the early part of the year with a stack full of tax documents and having to explain all the wash sales that happened throughout the course of the year. That is not a fun experience, as I'm sure we can all attest.
Barrett, I would just quickly add that I think to properly use direct indexes, and this is something that I used to do, I would run what we would call active passive portfolios. It was a combination of an index ETF with active managers around it. But I don't think you can do that with the direct index and get all the benefits that you want to get, including the tax efficiency and the after-tax excess performance. I think you've got to make a commitment that your core allocation is going to be passive in a direct index, because if you get too nuanced, I'm going to find this one-off active manager and then this other one-off active manager, as you've already said, you in essence neutralize all the benefits that you can deliver to a client, and it becomes a zero-sum game, maybe a negative-sum game.
That's right. So let me ask the advisors on our panel. So what about a demand for ESG? Are you hearing that in the marketplace? Is that starting to kind of froth up and bubble up to the top of your client base?
Of course, although I'm in Texas, so they're a little less driven by ESG than some spots, but absolutely, ESG is a real driver of client demand, especially the younger clients we find.
Okay, so I guess, and so to that end, then how do you implement ESG? Should a client approach you and say they want to put on a carbon neutral screen or whatever the case may be?
We work with you.
That's the right answer.
Adhesion and Clint, our CIO, to put a screen in to make sure that we're fulfilling that mandate. So there's no way we could do it on our own. It would be virtually impossible to do it without your services and a direct index structure to fulfill that client's mandate.
Got it. What about Jimmy? What about you? Are you hearing the need for ESG?
No, I'm not. I would probably be a contrarian and probably discourage that, because I think, again, I'm not going to get into the debate of the value side of ESG. It just seems to be subjective, because what I'm trying to do is deliver something that is simple, understandable, that's repeatable, and that has a historical basis without a moving subjective target. An S&P 500 index, a Russell 3, a developed international EFA index, that's a known. I think, again, I don't want to get into the value discussion. I just think the ESG space is a subjective space that has a moving target. And for my clients, I don't want to be part of that. I want to deliver what is predictable, what is known, and what is repeatable. So I don't mean to light a fire here, but for me, I would probably discourage anyone coming to me looking for an ESG solution.
Got it. Well, that's a good point. Go ahead.
Well, I apologize for saying, not only do I serve high net worth clients, but our platform, but Work Partners, are really a private wealth platform with an independent pricing structure. So we allow these advisors to run an independent practice, but give them a lot of resources. So it's truly a private wealth experience. What we found is we have to offer this because there's just certain advisors. we were speaking to or working with a woman in Seattle. Her entire client base will not invest unless they have this outlet. And this platform is really the only way we can do it. So there is a segment of the client base that without ESG, you're just not going to be able to serve them.
Right. Yeah, I was going to add to that too, guys. I see it, I deal primarily with financial advisors like Michael just referenced. And I mean, we have everything, not just ESG, but it gets even more specific, more specific than that. Like we work with faith-based advisors who are dealing with donor advised funds or Christian organizations and endowments. And they have a specific mandate that they need to build this. And this is a very attractive way for them to attract and also add value from a relationship side of things, right? To meet the mandate of the client. They're just meeting a client need. And what better way than to do it through a direct index where, to Jimmy's point, there is some predictability, right? There is a way to manage expectations to execute at a high level, but you get to align, right, by adding these overlays, align their values with their investment results. And again, you set the expectation from a tracking error. You can test it. It's math. It's computing power. You have the tracking error, right? It's more negligible in the ESG, or it's not as negligible in the ESG space, a little more pronounced, but you at least can set and manage expectations to that. So I'm seeing it a ton, but it is on the advisor level. Again, I don't work within clients. So I think that's the great thing is it's just another tool in the toolbox to solving client need, creating an exceptional client experience, and matching up with those values and needs of the end user. And I think that is the ultimate spirit of direct index, and ultimate spirit of investing. And again, it goes a long way to building what I call a behaviorally palatable portfolio, which is not always equal to a mathematically optimal portfolio. And I think that's an important distinction, something that we all have to remember, because at the end of the day, we're all driven by the same mission: maximize in the end user, the end client's value, right? That's what we're there to do, is to enhance their situation. So I think that's an important component to it. And so that's where I'm seeing the demand.
Yeah, I agree, Clint. I mean, go ahead. I'm sorry.
Well, I was gonna mention that I think that makes a lot of sense. We've historically seen a significant demand for ESG. The challenge outside of the direct index space is, how do you implement, ESG obviously with an ETF or mutual fund portfolio that doesn't make any sense. And then with separate account managers where there are individual holdings in the account, it's difficult to ask a separate account manager to build a one-off portfolio that has your client's very specific screens in place. And so the direct index is a fantastic vehicle, because as the direct index is being assembled and the whole thing is going through the construction process, we can take the inputs to the ESG process and weave them into the design of the direct index. So if we know up front that a client wants, a carbon neutral with income orientation and, maybe without over concentration to a specific sector, we can build that going in, and we can build a very customized, what we call personalized index for the advisor to use. So we're not putting these screens on top of active managers, which we do not believe works very well. Anyway, Michael, what were you going to say? I'm sorry.
I was just reiterating what Clint said, and you just said is the behavioral aspect of this, especially dealing with successful ultra high net worth clients. They want to have a hand in the construction of their portfolio. So it's more of a partnership with those clients rather than a client vendor relationship. And what direct indexes have enabled us to do is build that customization. But in years past, when we build that customization in, something would fall off because it wasn't scalable, precise, and repeatable. What indexes allow us to efficiently customize to those clients' needs. So you build that partnership, but you do it in a systematic way so the client stays on track.
Yeah, I think the key is, I totally makes sense. I think the key is, Clint mentioned earlier, is making sure that going into the equation that we're into the relationship, that you're setting expectations that, there may be a more pronounced variance from whatever the predicted return might be, because we're putting an ESG screen on top of it. But, obviously sitting down with the client in consultation with them and talking about building a very customized, personalized portfolio, that's a fantastic conversation. So you're right. It's a partnership. Well, fantastic. So I wanted to move on a little bit, and I thought it would really be an interesting conversation if we chatted a little bit more, with Jimmy and Michael about how they're using direct indexes. I mean, how do you see this? Are either of you in recruitment mode and thinking about how to bring advisors on? I know, Michael, you mentioned that a moment ago, that as you were bringing on advisors, it became a topic. So how do you think about this as you're recruiting other advisors?
Well, it's just as in dealing with high net worth families, we're here to serve advisors and help advisors build their businesses. What we found is partnering with Adhesion on the direct index side, we're able to deliver more efficient products or indexes to meet the advisor's need and serve their clients. And we're often able to do it more efficiently from a cost standpoint as well, which has been a big edge in helping us move advisors over from other firms. Also, we've got a pretty sophisticated CIO who runs a process and a framework thereby through which we make investment decisions. And direct indexing allows us to implement that framework in an ongoing scalable manner so that they're serving their clients efficiently, and not only from a tax standpoint, but an investment standpoint, but also so that they can stay on top of this framework throughout the process, throughout the business cycle. So it's been really effective in attracting advisors. And we talk about the growth in the space, and everybody knows about it, but the reality is, in my day-to-day interactions with most advisors, it may be growing from a very small number, but most advisors don't know about this. So they don't know that they can gain access to what they deem to be an SMA at the surface that's much more cost-effective, and they have the ability to customize to client outcomes at a much higher level. So for us, it's been a secret weapon because many of our competitors don't offer the same level of sophistication in this area.
I think for me, I'm a relatively new person into the RIA space, spending virtually all my career since the 80s on the BD side. So I'm in the process really of learning the RIA space, which I would suggest that is the fastest growing space for a reason, that all the technology and solutions and availability that you have to truly give a client a best of breed experience is on the RIA side now. So a lot of my focus at this point is actually in client acquisition and transition. So let me take the conversation a little differently. In a world where you don't have a direct index and you're bringing in a client with new assets, they may have had individual securities, SMAs, mutual funds, and ETFs, and then you bring them over to a platform where what they had at the other place is not really available where you're at now. So you have to go through, and you guys will know a lot about this, the old manager mapping thing, where you try to map in the individual securities and holdings that a client may have had with another SMA manager and find it with a like SMA manager, so that the disruption, the tax implications of all of it isn't really becomes a great negative and deterrent for someone even transferring their assets to me. Direct index is the secret sauce of bringing in new assets, because it doesn't matter how many SMA managers they've had, what their style is, what they've done in the past. We can create a direct index that embraces those existing holdings, then even create a tax mandate to make sure that in that transition that we don't create that tax bill that we don't want the client calling us about, through utilizing the team, particularly at Adhesion, which I've used very much in this whole process. They would take all these holdings, and then they would look at the account and say, well, Jimmy, based on what you're bringing in, this is a Russell 3000 direct index candidate. When we bring it in, we do the tax analysis, what is acceptable and not acceptable. And so if you're in the mode of bringing in assets and trying to do it in a tax efficient way and at least disruptive way, There is no tool out there. There is no solution out there that is a close second to using direct index to solve that problem.
Well,
it's interesting to me.
Point. Go ahead.
It's interesting to me as we recruit and as we talk to advisors. I'll ask Clint a question. Do you ever hear clients, when you meet with private clients, talk about a famed money manager anymore?
I don't. They never. I never hear one. I mean, the only time manager comes up is
Peter Lynch. Peter Lynch is retired, right?
Yeah.
But they're very sophisticated and they understand holdings, right? They know NVIDIA or Microsoft, right? So they, in our experience, are more driven by those holdings, probably because they watch CNBC all day. And what's so great about direct indexes is they can see those holdings, they can apply the discipline framework, because they just don't care about those managers anymore, in my experience. But maybe I'm wrong. Maybe I have a limited scope.
I think you're exactly right, because you used to hear about that back in the day. Anybody remember David Dreaman, for example, back in the 80s was the manager of managers, and so. But that is the case of which I made earlier. Pardon?
You're dating yourself, Jimmy.
Now, there's a long list of managers that had their time in the spotlight, but for reasons not because they woke up one day and became illiterate in being money managers. It just is a fascinating process to watch how active managers, for reasons that have nothing to do with their intelligence, move out of favor. But I will say this, that is an interesting theme that I'm starting to incorporate around the direct index, is that you'll hear people talk thematically. For example, one of the things that you can hear clients talk a lot about is cybersecurity. And you know what they say about cybersecurity now, and the need for it. There's only two kinds of companies now, ones that have been hacked or ones that are about to be hacked. So what you can do is take your core allocation direct index, make that 90+% of your equity allocation, and then possibly on this tactical side, I would rename it a thematic side. You might rename something thematically where you own a cybersecurity ETF, or you might own something that's related to power and energy. So I feel like the discussion, as you said, is either around individual names, but I also find it fascinating that they're picking up on thematic things like the medical field, biotechnology with COVID vaccines and things. So that's a unique way in which you can satellite and attach something around your core direct index.
Yep. And so earlier you made mention of the idea about transitioning assets too, and that's a fascinating conversation. We have it with every single advisor we bring onto the platform. It is a nonstop, constant thread of communication. And you know, one of the areas of the direct index, and I think Jimmy, you pointed this out, one of the areas of direct indexes that is so incredibly powerful is as advisors are going independent or moving off of their old legacy platforms, they're stuck, to your point, with low basis legacy holdings that don't have a home. And so what may have been missed in the earlier part of the conversation is there is a process to take, you know, to build an advisor their own custom direct index if needed. And one of the things that allows you to do is, rather than having to liquidate all the old legacy holdings, have a massive tax bill to go with it, instead you just absorb those legacy holdings into your direct index. And the next thing you know, you've got, 130 holding Russell 3000 with made up of mostly transitioned in legacy holdings. No tax cost to speak of, no commissions, and, you know, a relatively low cost portfolio that's now very customized and specifically tailored to the client. So yeah, the transition benefit helps too. And we've heard so many advisors breaking away, thinking about using the direct index as a tool for absorption purposes. And I guess, Jimmy, that's your point, right? Is that's a valuable tool there?
Oh, it's maybe the most valuable tool of all if you're trying to build out a firm, because I don't want to get into the discussion because it's a loser's game. You know, there's another, I'm dating myself on a book by Charlie Ellis. It's a loser's game for me to suggest that, Mr. Prospect, you've had manager XYZ, fund XYZ, and if you come to me and allow me to manage your assets, I've got the better manager. I've got the better fund. I mean, that's just fiction. That may be for a year or two, but ultimately it's going to roll over like the others. Whereas I can tell a client or prospect, you come to me and we will create a direct index with the least tax impact, but we're going to bolt it on to a known index that is representative of what you already own. And from there, through tax management, I'm going to deliver you consistent index returns. And you can look for that, and I can actually do that versus playing that game where, you know, I'm the greatest money manager research guy ever. Well, I'm not. I can't do that. But what I can do is create an index that embraces these holdings. And as the Adhesion team did for me, would take a very substantial client and say, this is a Russell 3000 index, and we can take your holdings, pare it down to about 150 names, give you Russell 3000 returns with a tracking error that's statistically meaningless with all the tax management. Why would I not do that rather than to go out and try to do the old school thing that we're going to find a manager that's most closely similar to the one that you had, and we'll manage in those holdings, and he'll take in holdings that he doesn't otherwise own or even want to own. I just don't think that is the best way to transition assets when you have the best transition tool available to mankind. It is direct indexing.
And is it safe to assume that you're introducing this concept to your clients? They're not walking in the door saying, "Hey, what's a direct index?" This is truly at least for now, kind of a hidden tool, is it?
I think I have the greatest clients in the world, and they entrust me to provide them the very best solution. So it's really just a function of me sharing with them what I think is the best way to manage their assets, the most consistent way, the most tax efficient way. So my relationship with my clients would be a little different conversationally than it would be with a prospect. But I just think that the prospect would take more of the tone of what I just said, where we can take what you have, create a direct index, and actually provide repeatable direct index returns. I think that's a great discussion to have with centers of influence like CPAs and accountants, because how many of advisors have they come along and said, I can put together the greatest portfolio of managers and funds and ETFs that you've ever seen on the planet. And it's like, oh, you're the one we've been waiting on, because I've never heard anybody say that to me before. Whereas you can come in with these centers of influence and offer them a solution that is a fastball down the middle for someone who is a tax advisor. We're going to give your client those returns they haven't been getting, and be able to work with you in concert with what the tax issues and mandates and constraints there may be, and make sure that we work together in achieving these returns on the most tax efficient basis. That is you can't have the conversation with that kind of purity and clarity with any other solution than a direct index with a CPA or tax advisor.
Yeah. Yep, I think you're completely right. Well, look, hey, I want to move into Q&A now. I think I know we've got a whole bunch of questions queued up, and so let's go and ask some questions from the audience. All right.
Yeah, why don't we take Barrett? Why don't we take there's one here that you could probably address pretty quickly, and another one it would be good to get the input from the guys. We have one of the audience member asks, if a client has a large ETF position as their core portfolio, how do they convert into a DI?
Yeah, so that's a good question. Unfortunately, it is not as easy as unbundling the ETF and all the holdings come spilling out. Obviously, it would have to go through a sale process, and then we would take the proceeds and invest it directly into the direct index.
And another question that maybe get a little input from each of the panelists. The audience member wants to know, in a nutshell, how would you go about implementing a direct index for a client? And each of you has touched on some aspects of that, but maybe each of you can take a quick stab at, well, what would be your approach initially with the client in order to build a direct index for them? And Barrett, I don't know if you want to kick that to a particular one of the panelists, or if any of you guys want to jump in.
Yeah, it's interesting to me.
Go ahead.
We don't really talk about direct index, right? We talk about what the client wants to achieve. We talk about maybe certain particular interests, themes, and from there we construct a portfolio looking at the underlying holdings. So it's really not very different than what a traditional financial advisor would do, except you're building it out through a direct index rather than managers, and it's built around themes, desires, goals, and outcomes. And from there, we construct the portfolio. So we don't really talk about direct index per se. We talk about themes and holdings, and then construct that portfolio in order to meet their goals.
What about you, Jimmy? I mean, how would you encourage an advisor to think about implementing direct indexes? Obviously, you have advisors on the line. They're here because they believe in the concept. They want to understand more about it. I know you mentioned that your clients are fantastic. Would you recommend first having a conversation with your clients about what a direct index is, or is it simply part of the portfolio construction that you deliver? How does that? How might you?
It's really more part of the portfolio construction deliverable. Obviously, we can explain what it is, but to the point that's already been made, you have to develop a portfolio around the objectives of the client, what they're comfortable with, and then once you agree on what that looks like on an asset allocation basis, it's basically just plugging in the direct index where it's appropriate. I think the direct index, in terms of implementation, it could be just your core large cap allocation, just to give some ideas, some practical ideas. I could use an S&P 500 direct index, and because of the size of the account and the optics of not having so many positions, they go blind looking at it. You might insert ETFs that represent mid and small and international. But I think really the most important thing is developing that portfolio and that allocation that's appropriate to the client. And then you simply present direct indexing as the best way to implement that portfolio.
That makes sense. Davis, do you have any other questions that you want to tee up?
Yeah, let's. I've got one here, pretty specific. If done in a core satellite, how do you know the index core is tracking the index you are replicating?
Yeah, so I can take that. So certainly on the Adhesion platform, we have the ability to show advisors exactly how that direct index is tracking, right? So I think Jimmy mentioned it earlier, but we do have statistics on the direct index. It's in the client's account. We use what's called a sleeve structure, so the advisor can log right into the client account. They can see all the different sleeves inside that account. They can open up the direct index, and they can see it right there. Now, the tracking error is typically the metric that we use to measure alignment to the underlying index. And so the advisors can understand the tracking error. And we've also put bands on the tracking error. So the advisor doesn't really need to monitor it per se, but we can put in bands around how that drifts away from the underlying index. And that's typically the best metric, is defining how far they want it to go. Now, of course, there's a inverse correlation. There's a relationship there. If you want it to be very tight to the index, then there may be a little bit more turnover in the portfolio. But if you allow it to drift a little bit, then obviously you can see a little bit more less activity in that portfolio.
I failed to speak up a minute ago. The basic sales technique that's been very impactful when we do actually bring up direct index versus another product. There are a handful of popular strategies that clients will bring up that they access through an ETF, and we're very succinctly able to say this is a less expensive way to access that strategy. And then you add tax harvesting on top of that, it's dramatically less expensive. So I can't, and sometimes on these calls we get to be a little esoteric or move into the weeds. I mean, there's some basic bottom line. We can offer you this direct index that follows the same strategy as that ETF, and we can offer it to you at a reduced price, and we can do the tax overlay. I mentioned that earlier, but there are a number that we were able to have that conversation, and it's a fun conversation to have because that's hard to do these days.
That's a good point. I would encourage folks who are looking for numbers, who are looking for case studies, and want something that's a little bit more concrete. I would really encourage folks to think about downloading the packet. There's a packet associated with this webinar. It does talk a little bit more in concrete numbers. I think somebody said earlier in the conversation, the active tax harvesting element of the portfolio and how that works with direct indexes, that provides, and we've got historical numbers on that, and that provides consistent year-over-year value. Markets up, markets are down. There's a fairly predictable number that you can expect to get from purely tax harvesting your portfolio. That number actually goes up a little bit more if you're using a direct index inside of your portfolio. So if you're tax harvesting all of your everything inside the portfolio, that's one number. You put a direct index, it goes up pretty significantly too. And that's a number that, to your point, Michael, that's a good conversation to have because they're not small numbers. They're pretty significant,
yeah, right.
fairly reliable, fairly predictable numbers year over year over year. So please download the packet, and there's a little bit more information on how that works. And the numbers are impressive.
Barrett, also, I think to stress the cost issue is, again, getting in this conversation of passive versus active management. The cost of an average SMA, 50 basis points. Is that fair? A direct index could be 15 basis points or less. Then you throw in the tax management. So already the direct index, you're spotting them 35 basis points ahead of the active manager just in cost alone. So the tables are tilted quite dramatically in the direct indexing, being that deliverable potential outperformer through the tax management system.
Yeah, and I'll tell you, it's. I just had a conversation with an advisory client of ours yesterday, and they were explaining how having that exact conversation about tax management, what we call tax alpha, the predictable after-tax return benefits, how in this, in this day of fee compression, how advisors' numbers are coming down, being able to say, hey, look what I've done for you, is a way to kind of insulate them from their own fee compression. So it's also a way to think about kind of defensibility around a reduction in fees. It's, geez, look what I've done for you. So we're not talking about beating the market. We're talking about this predictable year-over-year tax alpha. So it's a very good strategy. All right, we've got, I guess, a time check here. We got about a minute and a half. Davis, are there any other questions, or do we want to wrap up?
It's time to wrap up. I'm afraid we are out of time. I'd like to thank our speakers, Barrett, Clint, Jimmy, and Michael, for an outstanding presentation and discussion. We would also like to thank Adhesion Wealth for making today's webinar possible. As a reminder, you will receive a follow-up email that will include a link to view a recording of today's presentation. So if you found this event useful, please share it with your colleagues. Once you leave the event, a short survey will pop up in your browser window. We'd appreciate it if you would share your feedback on this event, as it helps us to provide you with content that is the most relevant and interesting to you. On behalf of wealthmanagement.com, thank you and enjoy the rest of your day.